Okay, good. Well, it's a pleasure to be here. The company that I'm with is pagetrader.com. PageTrader has been around for about 14 years. Most of you probably have not heard about us, but we've been around for 14 years, and I have developed a number of unusual methodologies, technical analysis methodologies, that I've been able to perfect. Next year, this time, will be my 25th year in front of markets each and every day. We have a series of products that are designed for people who are looking for highly specific forecasts for things that are going to happen in the future in the markets. And today, I'd like to talk a little bit about the outer limits of technical analysis. Now, most of us are well aware of what technical analysis is. Technical analysis is the act of attempting to forecast what the market's going to do under a given set of conditions, and then hopefully invest your money into those conditions. That's what technical analysis tries to do. And we've had some very bright technical people over the last 100 years who have developed untold numbers of methodologies that we've all seen and used. Everything from moving averages to, gosh, even the most sophisticated stuff with Fourier analysis and so on. Several years ago, in my studies of the market, I had developed a few methodologies that I've now brought to a new level, which I believe supersedes what is capable today from technical analysis. One of those methodologies is called the roadmap principle. The roadmap principle is what I'm going to focus on today, although there's one other principle that we utilize in our trading and in our forecasting, and that is something called reflected wave. So the two methodologies, these are just the names, and I'm just giving them to you so you can make a note of it. The roadmap principle and reflected wave. Let's focus on the roadmap principle, and I only have 30 minutes here, so I want to go through a little bit of this, but a lot of what we know about the markets, if I was to ask a show of hands, how many people believe the markets are random? Just a couple? Okay. What I'm going to show you in a few moments here, and that's fine if you do believe the markets are random, it surely appears that they're random, I know that. What I'm going to show you is the results of forecasts that we have made all the way up till today, just in today's markets. But going back in time, forecasts that we've made utilizing the roadmap principle so that you can see for yourself, and these were all made on live radio or live to the public, one way or the other. So everything I'm going to show you today and everything that's in your paperwork that you're carrying around with you there, all of that is that's just a few random selection charts. These are not cherry-picked. These are just common stock charts and commodity charts. Then I want to tell you a little bit about the roadmap principle, because I'm sure this will whet your appetite. All of what I'm about to show you is available daily at pagetrader.com, so if you would like to, you can come over there and take a 2-week trial of what we do. You'll probably see 20 of these kinds of forecasts utilizing the roadmap principle. I'm more of a researcher than I am a trader, but I do want to tell you that we do trade, and we do have a publicly accessible trading statement that goes over the past, since March or April of 2011, and that trading statement has been confirmed by a brokerage. And I want to give you the name of the brokerage. It's Daniels Trading. They're in Chicago. The broker's name is Bert Schlichter. His name is Burton Schlichter. And gosh, I almost would like to give you their phone number. I almost have it on the top of my head, but I don't. 66928. I'm not sure if I have it. I'm getting Daniels Trading. The reason I'm telling you about Daniels Trading is because Burton Schlichter has reviewed the statement that we have produced using these trades, and he has access to the real account and so on. I want to give you a little bit of an example, so this will whet your appetite. We started with about 100,000, maybe a little more, back in April of 2011. And as of the finish of last quarter, third quarter of this year, the statement's at 689,000 in real money, real dollars. And we're using this new paradigm in technical analysis to put these trades together. So let's go through a few of these, and then I'm open to questions, but I want to give you as much information as I can so that you can at least take a look at what we're doing here. This trade, this right here in front of you on the chart right now, this is crude oil. And just back on November 19th, with crude oil trading at a level of about $74.20, all of our clients, subscribers, got the information that on Thursday, today, the 20th of November, crude oil would trade at $75.75. And as you can see, crude oil was trading at $74.20, which is about $1.30, about $1,300 per contract below that. Today is the 20th of November. It's Thursday, and today's high in crude oil, as you can see, is $75.90. Now, if you look through the paperwork you have, you'll see this is not just an ordinary, or this is not just a well-selected example. This is a common event using this form of technical analysis. And I want to show you a few more. So let's go through this. Here is another crude oil trade. This was given out today, Thursday, November 20th, with crude already advancing towards $75.75, and we gave a new long position for crude to get long right here. This was just taking advantage of that already existing forecast. If you want to see all the crude oil trades that we've recently taken, and crude is just one of the many markets that we trade in, let's just type in crude, and I can show you any number of them here. This forecast, I think you'll find very interesting. I wish I had a pointer, but if you take a look at this, this is actually forecasting two completely separate moves in advance. Pretend this is a pointer and that it has a laser beam, and then you'll know where I'm pointing. Okay, I'm going to actually step over here because I just want to make this clear. This is the starting point. None of this had happened. From this point, the instruction was to allow crude oil to decline, that it would decline to $74.40 to $74.20, and then it would advance from that price to $79.50. So we're talking about two completely future, not happened yet moves. Crude oil declined and made a low of $78.35 against the $78.40 to $78.20 buying territory, and then immediately turned up and went straight up to $79.85. Now that's pretty remarkable considering none of those events had happened yet. All of our clients got that information in advance, and this form of technical analysis is brand new to everybody. No one knows what this is because it's never been published, and the methodology of it is actually too complex to even verbalize to you now, except I will tell you this. It allows us to forecast with great specificity where a market's going to be at a very specific point in the future. And when I say a point, I mean an hour or a day or some time period. So this is what we call a two-step roadmap. It means two moves have occurred, and you have been able to take advantage. A person could have, but we didn't. We did not take the trade down from here to here, but this trade is the trade that we were setting up for. So I hope you find that at least interesting. It's not something that's capable to be done with any form of analysis that I presently know of, nor do I know of any published analysis that would allow somebody to do that. We also put these trades out on live radio from time to time, and if you come to our website, pagetrader.com, you can go to those radio stations and check, listen to us on the radio where I'll give those trades out and I'll give these forecasts out. Let's go through a few more here. I don't want us to stick with crude oil, though. I want to show you a few other markets, but let me go through a couple more. I'm just picking these randomly here. Here's another one, July 16th, buy August crude oil above 103.30 for an advance to 103.50. Well, this is a $2,000 move. And from this point forward, you can see the market ran up and went straight to 103.94. If you look through the charts that I gave you in that little pamphlet there, you will see that almost in every case, when a forecast is given, very shortly after the call, the market has an explosive move right to the number that we're talking about. That's a very sophisticated piece of work that's going on there, because we know the timing of when that price is due, and we're forecasting the move just prior to that beginning, to run to that level. We had to hastily put these together for you, so that's why they're just stapled together. We could have done a better job, I suppose, but I wanted to give the information to you as it is. Somebody name a market that you are trading in, because I don't want to stick just with crude. Just let's go through a few. Some of them we may not have, so please. We're not doing that one right now. But that's okay. It works on the Russell, but it's one of the markets that we're not. What's that? Gold? S&P? Let's do the S&P. You guys like the S&P? How many people here like day trading? Okay, I'm sorry to see that, and I'll tell you why. Let me have a minute of your time on day trading. One of the reasons day trading is so difficult is because you're making a larger number of decisions trying to make a small amount of money. Aren't we all trying to make $100 per contract or something? And you're doing a lot of decisions in a very short period of time. What we're doing is we're making dramatically less number of decisions, and we're making dramatically more per trade. And that means your trade efficiency, which is how much you make per contract, is dramatically increased. So the day trader, in order to make $2,000 per contract like we're showing you here, he's going to have to trade, if he gets it right, he's going to have to trade 20 times at $100 per click, per trade, to get what this one trade did. And he's not going to be right 20 times out of 20. He may actually have to trade 30 times to get what we got in one single trade. So the efficiency, the gas mileage, if you will, of the trade is dramatically higher because we're not trying to go after very small amounts of money. There's one other thing I want to point out, and we bring this up in our webinars all the time. If you are, anybody here ever gamble? I don't consider the markets gambling, but you know, gambling at the tables and so on. There's a thing called the reversion to the mean, and the reversion to the mean means that if I were to take some coins and flip them here, if I flipped 10 heads or tails 10 times, I might get 8 heads and 2 tails on 10 flips. If I flipped it 100 times, it'd be probably more likely that I'm going to get closer to 50-50. And if I did it 1,000 times, 1,000 flips, I'd probably be stuck at about 50-50 by that time. The reversion to the mean is a natural principle that means that if you make lots and lots of decisions in your trading, you're going to be fighting against something called the reversion to the mean that none of us have any control over. So if you don't have control over that principle, you don't want whatever edge you have working against the reversion to the mean. That means your trading decisions are going to tend to be 50-50. Let's go to the S&P. I don't want to spend too much time on that subject, but day trading is very difficult to do for reasons that have nothing to do with methodology. It has to do with the number of decisions you're making. That's why this is important. So I'll put up some S&P. These are all probably going to be recent S&P trades. I'll just put them all up. Here is a 2-step S&P trade. This is a roadmap utilizing the roadmap principle. You'll notice that before the market got up to the high where we were saying to sell it, Thursday, October 30th, 8:39 in the morning, the S&P can be sold short between 1975 and 1978 for a tradable decline to 1969. When that was done, when that was said right there, obviously none of this had happened yet. The market pulled down and went straight up to 1978, the number printed over here, and went from 1978 straight down to 1968. All of this was given out in advance publicly to hundreds of people all around the world. And any of you can come listen and watch these trades as we put them out. It's not that I'm a guru, it's that there's a principle in the market that has yet been undiscovered that I am utilizing to call these kinds of moves. I want to show you a few more. And I'm just picking randomly right off of my documents folder here, which has every S&P trade we've done. Here's one, October 20th, a daily close today above 1892, can be bought for an advance to 1904 to 1905, and then 1925 to 27 profit target. This is a two-step roadmap. The market then advanced. This is a 60-minute chart. I'm moving my cursor up. It advanced to, there's the 1892, 1893. It's closing above it there. Here's the gap open. It went to 1904, 1905. And then it went on from there all the way up to 1928. This is a 27-point move in the S&P. A day trader is going to have to trade, a guy that's going for a 1 point is going to have to trade 27 times, and he's going to have to be right every one of those times to take advantage and get what this one trade offers. So our company offers these types of forecasts, the results of this roadmap principle, to people like yourself who are serious technical traders, so that you can start putting this to work in your own trading. And I would really like all of you to take a trial. No one will bother you. No one will even call you. You can take a trial, follow what we're doing for 2 weeks, and see if this type of forecasting can be useful to you. There may be a point in the future where we will teach this methodology, but it's complex. It's not something that you can easily sit down and say, oh, I just use a moving average and then it's nothing like that. It actually has too much complexity to teach to a group. I'm going to show you a few more on S&P, and I want to take any of your questions. Here's another one. This was Thursday, November 6th. Hourly close above 2022 should be bought for an advance to 2032. That's a 9-point trade. The market was right here, had not broken out yet, but the roadmap principle was forecasting that it would break out to new highs. And here's the high, 2033. Somebody name another market for me. Let's go through a couple others, and then I want to take some questions. We don't have we have a few natural gas trades that we've taken, but in fact, let me check it because I know we have a couple. It's interesting that you are looking at natural gas. Most traders don't even consider that to be a tradable market. We have, and we sometimes do. So we do have some natural gas trades. There's quite a few of them. Here's one, November 6th. Natural gas should advance from the current prices, $355, to $397 to $98 into December, and then it doesn't, into December, which is the month of December. So we're forecasting down here at $355 that this whole move that you're seeing here is going to happen. And natural gas, that was $4,000 per contract. A day trader is going to have to trade 40 times for $100 to get it right every time to get that move. And the roadmap principle forecasts this. Occasionally, no one's asked me this yet, but is it ever wrong? Occasionally, the roadmap principle can be wrong, but it doesn't happen very often because we fully vet every one of these setups out. And by vetting, I want to describe what that means. We use an exclusionary process where what we're saying is, what is the most likely thing that's going to happen, and what is the least likely thing that's going to happen? We have our tools up, we have our stuff, and we're slowly eliminating, and it's an exclusionary process, what's least likely to happen, and that leaves us with the highest probability of what is most likely going to happen. That's how we're getting these trade setups. And it's as surprising and as unusual as it is, it almost looks like magic. It's just the act of high probability. So if I had to summarize for you what we're doing and what we're providing a new way to have a superior advantage in probabilities. Anything is possible, but what is probable? And that's what we're offering in this. We've learned to do it with the markets, and as I said, this has taken me a good portion of my whole life to put this together. Please. It does work on currencies. I'd like to show you some euro and dollar, if that's what you're referring to. It doesn't work on everything. It works on most things, though, and it does work on stocks as well. If you look through your paperwork there, you might see some. But let me just type in, let's say, the euro. I'm just going to pick one out here. Here's a euro trade Wednesday, November 12th, 124.22 to to 124.11 is buying territory in the December euro for a quick advance to 124.70. You can see what the market did here. It firmed up and it made a low. We didn't get into this trade because the subsequent low was 124.29, so we couldn't take this, but the market did go straight up to 124.80, which is just a few ticks off of the 124.70. In other words, just slightly higher. All of these trades that you see on the chart here, these are all euro trades. Here's one, Williams Edge, buy the December euro between 134.90 to 134.75 for a quick advance to 135.15. The market made a high of 135.13. I'll show you a few. I'm just picking these again, just grabbing whatever's in front of me. August 14th, buy the September euro at 132.14 for an advance to 134.49. That's a pretty good move. That's $3,000 per contract. This is a daily chart. 4 days later, the market made a high of 134.54. It's pretty amazing.
Your recommendations say where to stop?
We do, of course, yeah. It would clutter the chart too much to go through. But we do use stops, and I want everybody to know, and I know you know this, if you trade without stops, you're not really trading. You really are reducing your methodology to simply gambling. And to my definition, gambling is when you place a bet when you know the odds are against you. You may have a very powerful edge, but if you don't have a place to be wrong, the edge becomes meaningless. I'm sorry? Oh, did somebody have it? So, yes, please. I'm sure we have some of those. I hope I can find one. I don't mean that funny. I just hope that there's one that's easy to see because these charts are very small. I know we had one in crude recently, and let me show that to you. CL. Here's one. This is where we shorted the market at 81.50 and got stopped out at 82.40. So this trade, we were looking for a specific thing to happen, and essentially we had a close buy stop to protect ourselves from having the market run up. And there are other things that can happen. And let's be honest, we could be in the market and the market could begin to move up, we move our stop up, it pulls back, it spikes us out, and then it runs up and completes the target. That can happen as well. But that's trading. What I'm really addressing today is that I'm here to announce to you that there is a new paradigm in technical analysis. It's no joke. And it takes the probabilities of forecastability in the market to a new level. And we demonstrate that every day at PageTrader. You can come check it out. You don't have to spend any money with us. You can watch it for 2 weeks and get probably 15 or 20 of these trades. We have a product with stocks alone for those of you that are interested in stocks. We have a product for futures, which covers the gold and the crude and the euro and the dollar and the S&P and so on. And then we have one just for the S&P 500 for the intraday movements, but not for 1 point, the intraday movements for 10 and 12 and 15 points.
What would you say your percentages are?
Well, they're very high. I don't have the exact number, and I don't want to make a claim because past performance doesn't indicate future performance. You all know that. But my main purpose in bringing you here today and having you listen is that the common thought about technical analysis is that it can take you to a certain level, but it can't do this. We can now do this. It's now doable. Anybody can do this if they know the methodology. It's not that I'm a unique person and sees things in a unique way. It's a method that anybody could do if they practiced with it, and it does take some practice to put it together. I'm going to tell you in just a moment a little bit about it. Stay with me 1 second. Let's do one more market. I don't know how we are on time. Somebody will have to tell me. We okay? What time? We have 5 minutes? Okay. Well, let me tell you a little bit about the methodology. First, I'd like to tell you a couple things. First, thank you very much for coming. It's a pleasure to be able to speak to people who have an interest in this. Most people haven't heard of us. We've been in business for 14 years, and we do teach one of our methods, which is called reflected wave, over at the Mirage Hotel right across the street. We've had 12 seminars over the last 2.5 years, and people come after having seen what we're showing them, and let me put one other chart up. They come from all over the world to learn that method. We may teach our other method at some point, but it is complex, and its better use right now is simply as a something for people to take advantage of, rather than worry about utilizing it. It's hard to put it in a brief picture, but I'm going to try to put it for you in a brief picture. Everything in the world has 3 dimensions. Can you bring me anything that doesn't have a 3-dimensional quality to it? Can you pick something up and say, here, David, this doesn't have 3 dimensions? Everything has 3 dimensions. Even thinking is in 3 dimensions. Stock indices are in 3 dimensions. Markets are in 3 dimensions. Those 3 dimensions have a relationship to each other. And what we are monitoring is the relationship of those 3 dimensions. And we're doing it in a unique way that allows us to say that at a very specific moment, like what you see here on this chart, we know something big is about to happen. You'll notice here, October 13th, November crude can be shorted for further decline to 82.80 or lower. We put that out with the market at 84.50 right before this big decline. So what's occurring behind the scenes in those 3 dimensions is telling us that one of those dimensions has to do something, and that's going to cause this to happen. The markets indeed are not random. I can assure you, if the markets were random, what we're doing would not be possible. Because the market has the ability to, if it was random, it could go anywhere it wanted to. But instead, it's going right down to the very numbers that this is forecasting, time and time and time again. So I'm here today to tell you the markets cannot be random. Otherwise, unless we're really good guessers, and we're not that good. So, any final question I can answer, because we have 30 minutes and that's all the time I have today, please. It's unfortunate, but when I started trading, I had some friends. I know this is terrible, but I'm going to come clean to you. Let me come clean. And my friends wanted me to. I was new in the trading world, and they said they're at work and they got a pager. And I said, well, I'll page you those trades. That's how simple it is. That's how meaningless it is. So I'm sorry, but we don't have a really meaningful company name. Thought about. We have very long duration trades. That's another thing I'd like to say is many of these forecasts go out months in time. You can go to our site and check it out. We forecast in March of this year that in May of this year, crude oil would begin a near biblical size move. This was in March, and we're forecasting for May. The move actually began in June, 1 month late, and you know what happened to crude oil. It had a near biblical size move down. I'm going to tell you something that's hard to believe, but the future is not completely unknown. Parts of the unknown future are actually existing right now invisibly. And we are picking up on the invisible part of the knowable future. I know that sounds bizarre, but the future isn't completely unknown. And when we're forecasting that a force is going to hit the market of biblical size, which we did in the crude oil, and we did it on public radio, it's on live radio, so there's radio stations that have recorded all of this. We did that because we knew that force existed through this method, and it was going to express itself beginning in May or June of this year. And go take a look at crude oil. I know you all know what happened to crude oil. So it's very interesting, and we're doing interesting work. I'd like you to be part of it. I'd like you to check it out. Our packages and all the things that we have, you can give us a call. I'm also available at the office if you have any questions about anything that you might be doing with us or investigating. And I'd like to thank all of you for giving me a few minutes here today, because we're relatively unknown. I don't think we will be for long, but we're relatively unknown now, and I'm glad that you took some time today to come visit and watch what we're doing. I'd like you to take advantage of some of these forecasts in your own trading, and I'd like you to do it for free for 2 weeks, and let me know what you think, because everything I've shown you here today actually happened in real time as a future forecast, and you'll see it if you come check us out. Thank you very much for coming today. I appreciate your time.